Limitation of technical analysis. The efficient market hypothesis (AZMH) shows why historical price and volume data should not contain any actionable information. On the other hand, business fundamentals should also provide actionable information by the same reasoning. There are two forms of EMH, the weak form and the semi-strong form. Moreover, history does not repeat itself exactly, so price pattern analysis is of dubious importance and can be ignored. Assuming a random walk model is more appropriate for modeling prices. Technical analysis is also criticized for working sometimes, but only because it is self-fulfilling. Some technical traders place their stop loss or loss, a certain company's 200-day moving average. Once many traders have done this, the stock will be flooded with sell orders, which will cause it to drop, confirming the movement predicted by traders. Other traders will also see the price decrease and sell their positions, further reinforcing the trend. The short-term selling pressure can be considered self-fulfilling, but it won't make much difference to the asset's price in the coming weeks or months. If enough traders use the same signals, the price could move in the direction predicted by the signal. However, over the long run, this group of traders can determine the price movement over the long run. Lesson synopsis. An analyst uses technical analysis tools to analyze how supply and demand for a security will impact price changes, volume changes, and implied volatility changes. Trading decisions can be made solely by retail traders based on price charts and similar statistics. Any security with historical trading data can be analyzed using technical analysis. A trader's choice of technical indicators and the time frame and they consider are the two primary variables for technical analysis. If enough traders use the same signals, the price could move in the direction predicted by the signal.